First thing, regardless of whether you're going with an agency or you're trying to fix your credit yourself, it's best to understand the process. And the process starts with understanding your current situation, taking a look at your current debt, your income, expenses, seeing if there's a way to increase your income such as to pay off that debt, and then paying off the highest debt first. And also there is a split in terms of how the debt is structured. Let's say if you have equal monthly payments, you have to first make sure what goes into paying the principal and what goes into paying off the interest. Because if you're paying the same amount every month, chances are that you're paying a lot in interest and very less in principal. And even if you try to pay off your debt quickly, or maybe pay a larger amount this month versus the next month, maybe that's not in your contract. So it's also time to negotiate, and you can't negotiate if you don't understand what your current debt is. So first thing is getting an understanding of your current situation. Whether you go to a credit agency to help them, or to get them to help you repair your credit, or whether you're doing it yourself, awareness is step one. Second thing, understanding that this is not a quick fix. If an agency promises you a quick fix, it's probably a scam. If you've got a little bit of debt, and little bit meaning it's different for different people, but assuming your income is $100,000 and you're in debt of maybe just $1,000 to $2,000, for a college student who's earning minimum wage, who's still trying to pay rent, $2,000 is a lot of money. So it's relative to your income. So second thing, make that calculation. What percentage is your current debt out of your total income? And also look at if you can earn money different ways. So we also have another video about debt, but I'm just going to quickly summarize. First thing, never make a late payment. There are steps you can start taking to have a better credit history. Sometimes it's utilization. By that we mean that let's say you have $10,000 in overall debt, and your credit limit is actually $15,000 in your card. That means that you have covered a majority portion in the utilization of your credit. Let's say you had a $10,000 credit limit, but your utilization was just $2,000, which means 20%. Let's also take a look at the government's website, the FTC's website, to understand a little more about credit, because this is important. So what does your credit report say? One, it understands and can help you understand whether you pay your bills on time, what loans and credit cards you have and what you owe on them, whether you've been sued or arrested or have filed for bankruptcy. This is important because your credit history is pretty much linked to anything you do, whether it's applying for a house, getting a better quote on insurance, car payments, or even as simple as getting a mobile plan or a phone plan. Your credit report is being asked for. So if there is negative information in your credit report, what happens is that the bureau sells the information in your report to creditors, insurers, employers, and that helps them make decisions about you.